Folks, this is the most realistic and optimistic and comfortable Jerome Powell I have heard so far in the last 8 months. This was not a hawkish Jerome Powell. This was a confident Jerome Powell. He gave us clear guidance. He told us this is not going to be easy. It's going to be a challenge, and we are going to try to aim for a soft-ish landing. But if our plan doesn't work, we're going to have to screw you and raise rates more, and the market's going to suck. But here's our plan. We think there's a chance that inflation peaked in March. What we're going to do, though, is while we wait for confirmation that inflation peaked in March, we're going to raise rates 50 basis points now, 50 basis points in the next meeting, and 50 basis points again. That puts us around 1.75 to 2% soon. And that is still in the accommodative direction. Remember, if we had a Paul Volcker and the Fed believed we need to Paul Volcker the economy, you would get rates above where inflation are, or where inflation is. If inflation's at 8.5%, we'd have to see rates at 9%. That would be a rug pull. Federal Reserve Chair Powell says no, we don't need, or we're not even considering larger rate increases. He killed the idea of 75 basis points for now. It's entirely possible that they'll flip-flop. In fact, Jerome Powell, and this is something that I've been talking about on the channel, gave a very clear and, in my opinion, very credible explanation as to why they flip-flopped last time. Remember, in the summer of 2011, in the summer of 2021, while I was campaigning for governor, I remember the CPI reports coming in low. And it wasn't until the Delta variant that CPI started coming in substantially higher. And so that's what Jerome Powell was outlining when he said, look, we were in sync with the data in the middle to end of last year. We had weak job reports, inflation was trending down, and it really wasn't until post-Delta, late October, that we got strong job reports. The stock market was going euphoric. We had strong ECI readings, employment cost index readings. We had high CPI, and then they had to pivot. And so they've given us a very clear path for this pivot, which I really appreciate, because remember what Jerome Powell's, his number one goal is. His number one goal is to make sure that inflation expectations remain anchored. There are two ways you can measure this. You should know this by now if you watch this channel regularly. Number one, consumers. University of Michigan Consumer Sentiment Survey. What has that been showing? It's been showing stable but elevated inflation expectations. What are the 5-year break-evens telling us? What is the bond market telling us about market inflation expectations? Stable to declining compared to the peaks that we saw in March. Obviously still elevated from, pre-war era. This would make sense. So I believe that you had a Jerome Powell in January that was very much, we've lost control. We've lost the plot. We're way behind. This is a big problem, and we have to shift. That pivot has now caused about 5 months of hell in the stock markets. And Jerome Powell has regularly been asked this, and he dodges this every time. He dodged it with Sarah Eisen. He dodged it today. He regularly dodges the question of hey, well, do you need stocks to be lower to reduce demand? Because his tools affect demand. And the question here has to do with the wealth effect. If people feel poor, they'll spend less money. Well, he says, his response is generally, well, we look at everything. Credit spreads, debt, the equity markets, which is stocks, and that's just part of it. Okay, fine. So if the stock market goes too euphoric, who knows, maybe Jay Powell can come out again in a few weeks and go, oh, wait a minute, because that's literally what happened after March, and I want you to remember that. After March, the market rallied after the Federal Reserve meeting, and it rallied for 2 weeks to levels where we had almost retraced between 60 to 80% of market losses from all-time highs. And we're like, what? Should we really be back to 60 to 70% of all-time highs to 80% of all-time highs? Probably not. Sure enough, Jay Powell and the whole Fed team come out and they start talking about how, we're going to get a little more aggressive and bring the market right back down. So they're watching the markets. They're watching valuations. All right, let's talk a little bit more about where his confidence is coming from, though. His confidence seems to be coming from this idea that the economy is extremely strong and it's positioned to handle this tighter monetary policy. And again, their goal is to set these expectations by talking directly to people and markets that we are going to get inflation back down. Now, hopefully it goes according to plan and we start seeing more data come in that inflation continues to trend down. Jerome Powell wasn't hawkish about this. He was actually really realistic. He observed, hey, we've already had 2 months in a row of core CPI coming down. we're already starting to see some signs that inflation is coming down. As long as this is consistent, we're on a good path for a soft landing. If we get a big miss on inflation, it comes in hot, well, then obviously we would expect another Fed pivot. He's been pretty dang clear here. I don't think we could ask for more than this. However, Jerome Powell right now does see, and this is actually positive, household spending and business fixed investment still strong. Still excessive savings on consumer and business balance sheets. This is very unusual in a recession, right? This is a very good thing. Now, of course, in inflation, he does say inflation is much too high, and we understand the hardship that this causes to folks. Again, he's signaling to the world, we are going to get inflation down, and this signal is a way of setting in expectations. As soon as you get expectations unentrenched, you end up getting a Paul Volcker. Jerome Powell actually expressed his admiration for Paul Volcker, and in the minutes he was talking about like literally the 1 or 2 minutes he spent talking about Paul Volcker, the market like quickly turned red, at least in sort of the minute candles. And it's funny because it's like people hear Paul Volcker, probably algos hear Paul Volcker. That's not what we want to hear coming out of J. Powell, okay? Because Paul Volcker, he did force a recession, but he forced a recession when inflation expectations went unanchored. We have anchored inflation expectations right now, which is really good. And this is why Jay Powell thinks we are going to see inflation expectations flatten out, and that we've already seen evidence of flattening and peaking, but 1 to 2 months is not enough. We need more evidence. Now, I love this. He makes it clear, no wage price spiral. We thought we had a wage price spiral in January, but that data actually ended up getting revised in February with more accurate data. No wage price spiral. Wage price spiral is really usually evidenced by wages going up faster than the rate of inflation. We had that in January. That was a panic mode right there. Because if we went to wage price spiral, the Fed would rug pull us. And he says that. He literally says, we cannot allow a wage price spiral. Because that's worse. And like, you could have regime collapse if you have a wage price spiral. And obviously nobody wants that. So Jay Powell's right. Like, we got to get expectations and everything under control so that we don't ultimately have regime collapse. When he's asked about a recession, he thinks that, look, the economy's doing very well, good time to be a worker, and he says we have a good chance to restore price stability without a recession or severe economic downturn. I thought this was interesting that he kind of mentioned the severe economic downturn part, because he's kind of saying, like, but if we do have a recession, it's going to be minor. You know, it's going to be like a paper recession, which we've sort of been talking about. The fear is that a paper recession could freak consumers and actually drive us into a deeper recession, right? Labor market. Obviously, participation up slightly, but still a large lack of workers. We're at 3.6% unemployment. We have 11.5 million job openings, as we saw from the JOLTS report yesterday. That, with 6 million unemployed people, means we have about 1.9 spots per person. Now, I personally think of this as like the excess demand problem that you have in real estate, where you have excess demand for jobs, just like you have excess demand for real estate. So what do? You raise interest rates. Think about real estate and then look at how exactly it relates to jobs. With real estate, you increase rates. What do? Well, you take demand that's in the way excess, you drive excess demand down. That doesn't necessarily mean prices have to go down, right? That would mean demand has fallen below supply levels, or supply levels have risen. But you drive that excess demand down to a balanced level. The same exact thing is what Jay Powell is trying to do for wages. In fact, it took him a little bit to say it. But somebody asked, like, what's the ideal level, that 1.9 ratio? And I'm like, 1. It's obvious. It's 1. And it took Jay Powell, a minute or so to get to it. But he's like, yeah, I mean, like, a few years ago, we were at a 1-to-1 ratio. And we deemed that to be pretty appropriate at the time. Of course, there's a matching effect. Like, if you have the wrong people in the job market who don't have the skills for the certain jobs, you might see a different ratio there. But obviously, the point of markets is to have a balance between supply and demand. That's obvious. So no surprise there that when we're so hot on that ratio, 1.9 times the openings per workers available, we have room to bring that down with higher rates. We have room to bring that excess demand in this real estate market down. And we've already flushed out so much cash out of the stock market. It's no surprise to me that we're basically bouncing perfectly off the 0% fib here, because that's the bottom. Like, how many more indications do we need this is the bottom? Now, who knows? I can't guarantee it. A sack of rice could fall over in Biden's office tomorrow and he could go crazy, and the market could crash more. You just have no freaking idea. But this is now the fourth time we are bouncing off the 318.5 level on the QQQ. And if you don't see that as a signal, I don't know what more you need, okay? That's all I gotta say. But anyway, it is possible, obviously, that this here from the Federal Reserve could lead to some risk-on attitude here, because the Fed is giving us a very clear sense of comfort and stability. And that could lead smaller stocks, like we're seeing now, SoFi, Robinhood, and small caps to actually run as you get a risk-on momentum move. Just be careful. I think now's the time to kind of get into stocks. But if we start retracing back 50% again, 70% again, don't get surprised when the Fed comes out and starts talking hawkish again if it happens before inflation actually comes down. Jerome Powell obviously makes it clear that we're still going to have uncertainties coming from China, from Russia, and talks about how his tools work on demand, not on supply. There's nothing they can do to bring oil prices down. There's nothing they can do to bring wheat prices down. But what they can do is affect demand. Now, what I thought was really interesting here is he made it clear to us that they're not paying attention to the top line level of inflation. They're paying attention to, as expected, core CPI. Used car prices going down, core CPI is going down. These are the things we want to pay attention to. That doesn't mean it's not painful that food and energy prices are high, but the Fed is judging their efficacy on core prices going down. Okay, balance sheet runoff, they kind of randomly, it sounded like, picked June 1st, doesn't really matter. Very uncertain the effect of the balance sheet. But again, it's going to take 19 months for the balance sheet to even start affecting markets in terms of tightening, because the reverse repo market has over $1.8 trillion of cash, and they're only going to moderate or taper this down at about $95 billion after 3 months. You know, we gotta ramp up to a $95 billion taper. And so that's at least 19 to potentially 20 months that we have before you actually start seeing the tightening effect of the balance sheet runoff. Now, it's an oversimplification to do this kind of math like this, but it's roughly, if you're going to approximate, it's actually a pretty good approximation. So don't worry so much about the taper. Focus more on the trajectory of rates, and specifically core inflation and core inflation expectations. Those are going to drive the Fed. This, in my opinion, was a phenomenal Fed meeting. This was the most coherent and controlled that I've seen J. Powell, and the most certain he has seemed. I'm happy about this, and I wouldn't be surprised if it continues to push a risk-on rally. In which case, if you want to learn more about my perspectives, whether it's in the stock market or the real estate market, make sure to check out those programs on Building Your Wealth, linked down below. Now, there is a coupon code that is expiring on May 16th. That'll be our largest price increase ever because of all this inflation that's going on. The prices are never lower, so and they haven't been for the last 4 years that I've had various programs and have been adding content to these. So check them out. You get lifetime access to whatever content gets added. I got a couple of sweet real estate videos coming out as well for the real estate course, and the wealth course is getting a bunch of new access. So super excited. Anyway, that's the update for you on JPOW.